Broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. I'm Lisa Roos, the Director of Long-Term Care Insurance here at One Resource Group, and we want to thank you today for joining us. Today we have Brad Shepard and AJ Reiber from One America, and they'll be discussing LTC premium deductibility for businesses and individuals, as well as executive bonus plans and funding options. Please hold your question, or please put your questions in the chat box, and we'll answer them at the end. And for now, I'm going to go ahead and let Brad take it away.
Oh, well, excellent, Lisa, and thank you so much to One Resource Group for allowing us to have some stage time here and highlight some great things that we have to offer at One America, and also have one of our best teammates on the team join us today with our advanced strategies team, and that's AJ Reiber. But I'll introduce him in just a couple of moments after I do my thing. So AJ, if you want to just go on to that next slide. And so there we go, bud. All right, so what I want to do first for the first 3 or 4 minutes is some of you online today may be very familiar with what we have to offer here at One America Financial with our asset-based long-term care solutions, and others may say, how do you even spell One America? And that's fair, right? So let me try to help you with all of that in maybe 3 to 4 minutes. Just a treetops view of the solutions that we have, and then that'll set up AJ for talking about how there is the potential, and I say that keyword, potential, for either deductibility or using pre-tax dollars to pay for a part of the premium for these asset-based solutions. Now, let's start on the screen, and you can see on the left-hand side, and I don't have my cool little cursor outside spotlight the screen, but on the left-hand side, you see that's called the base policy. Now, with One America, we're unique in that we have not only products that reside on a whole life chassis, that's called asset care, but also we have contracts for LTC that are on an annuity chassis. And we're very original here at One America. We call those annuity care. All right, so you can tell I like to have a little fun with this subject matter. But why that's important is at the bottom of the left-hand side, truly, and I say this with all sincerity, if there's a way with US currency that someone could buy insurance, you'll see that listed there. Meaning, there's single premium, there's recurring premium. We can use qualified dollars to fund our solutions. And that could be qualified dollars for the existing owner. That could be qualified dollars for someone that just inherited those contracts from maybe a loved one. And then also next, you can see we can also use those non-qualified annuities. Just a little bit of teaser for a moment. I believe that using non-qualified annuities for our product suite is probably the most underutilized or underserved market from a consumer standpoint in the industry today. And there's plenty of legislation and tax-free advantages, even with gain there. So if you're not familiar with that, make sure you contact Lisa at One Resource Group to understand more. And then finally, what you'll see is some of the lazy dollars, even with cash value life insurance, or in this one, isn't necessarily unique, but it's overlooked in that turning on income from either a SPIA or other single premium deferred annuity with an income rider to pay for these products. Now, for those that are familiar with these solutions, why are a lot of clients liking them? Well, it's because there's truly live, quit, or die in them, right? So the live portion is that base policy that I just mentioned. That's what we used first when we pay for care. If the client files a legitimate long-term care claim, and it's the same that you're used to, either 2 out of 6 activities of daily living, or because of a severe cognitive impairment, we're going to use the base policy first. We're going to accelerate that benefit while they're still alive. Now, if they run out of that at the time of buying the policy, they could also add even more leverage. So on the right-hand side, now every carrier calls it something a little different. A lot of other carriers call it an extension of benefits rider. We just call it a continuation of benefits rider. Now that's pure LTC benefits. And what you'll also see from One America that's unique is that we're the only carrier in this space that offers unlimited or lifetime benefits. Now, we have limited benefits as well, as you can see there on the right-hand side. And these benefits are not free, right? You can see at the bottom, the funding options can either be single premium, recurring premium, and the like. So that leads me now to setting up AJ to take over, but I want to keep on this slide for just a second. Notice the continuation of benefits rider. Even in the illustrations, if you've seen an illustration from One America, if not, ask Lisa for one, and you'll see we clearly separate out our base policy premium and our rider premium. And in particular, where that works well is going to be on asset care. Now, we can still do that a little bit on annuity care, but let's just focus on asset care for a moment. So with that particular rider, the way that we file that rider is under tax qualified IRC status. So that's what's called 7702B. I won't steal AJ's thunder, but I just want you to know that that's the real reason why we're having this webinar today, is to dive deep into how potentially a client, whether they're an individual or whether they're a business owner or a key executive or partner within that type of business, and hint, hint, potentially even a spouse, right? AJ, you'll get to that in just a little bit, where we could have net less premium being paid in total for this strategy. So with that said, AJ, I'll turn it over to you, but let me just talk a little bit about AJ for just a moment. One, please excuse AJ, his voice may be a little bit raspy or hoarse during his time. We just had our national sales meeting, and some of us, caught a little bit of a bug, and so he's under the weather, but he's a champion. He came and joined us today. So if he has to pause for just a few seconds to take a drink or cough a little bit, please excuse that. It happens to all of us, right? So AJ, thank you so much. But AJ has been a part of the One America team for quite a while now. And in fact, he came up through the ranks. He was one of our best internal sales partners and decided to join the advanced strategies team. And I know he's a very busy guy. So with that said, AJ, I'll turn it over to you. And if you ever need, if you need some help while you're putting yourself on mute, let me know, okay?
Thank you, Brad. I appreciate it. Thank you for the opportunity, everyone, to talk with me today. This is a really exciting area that I think we're seeing a lot of momentum out of. So I'd like to go ahead and share that with you here. And what it is, basically, we're going to be talking about paying the premium in the business market. So that's what the conversation will be all about today. And basically, we're talking about paying the premium in the business, basically for both owners and non-owner employees. But really, to understand the value, we're also going to talk about paying the premium personally. So when we talk about paying the premium personally, we're going to talk about premium deductibility, first of all. Now, these plans are filed, as Brad indicated, underneath accident and health plans underneath 7702B, which means they are not ERISA plans. So we can, what does that mean? We can actually discriminate. So we're not subject to those anti-discrimination laws. We can pick and choose who we want to offer this benefit to, whether it's the owner or an employee, or just some employees underneath what we call, well, we'll get to this later, but a 162, section 162 executive bonus plan. Now, the deductibility depends on the type of taxpayer that we're looking at here. So whether or not it's an individual, an entity, like a business, and also the structure of the policy. Now, there's three ways that we talk about paying the tax, or paying the premium on the policies, which will directly affect the tax deductibility. First of all, an individual paying the policy premium using his or her personal checkbook. And then a business owner that pays the premium for himself or herself using the checkbook from the company. And then also the business owner that pays the premium for an employee using the company checkbook. So we'll look at all three of those different payment types. Now, why are we talking about this now? I think there's a few reasons. Number one is just the size of the business market. There's 33.2 million small businesses, according to the SBA, the Small Business Administration. And that was back in 2022, and that was last updated. And out of that 33.2 million, that makes up about 99.9% of all U.S. businesses. And they define a small business, the SBA does, any business that has less than 500 employees. So if you break that number down even more, There's about 27 million of those with no employees, just a mom and pop shop, and about 5.4 million in there with fewer than 20 employees, and then the remainder, about 650,000, have between 20 and 499 employees. So just a really big opportunity to be creative when we talk about placing a long-term care policy. The company checkbook. So we have all these small businesses, but people love writing checks for the company checkbook and paying for things. Even if there's not a deduction, people just love using the company checkbook. So I think this is going to be something that will really resonate well with your business owner clients. But one of the reasons that we see on the employee side is, if everybody's familiar with that great resignation, that challenging labor market. So, you know, back in 2021, according to the U.S. Bureau of Labor Statistics, there were 47 million Americans that voluntarily quit their jobs. And the causes were varied, but some of the leading causes were basically just inflexibility, low pay, but one of the biggest reasons, benefits. So as a matter of fact, NIA Health did a survey and did a study and said that one of the factors that's being overlooked the most is workplace benefits. So according to that survey, 90% of employees said that whether they stay or at their current job or look for a new opportunity, number one, it's going to be income. Second would be insurance packages. So that's really a significant factor when we're dealing with a challenging labor market. Now, a lot of organizations now have started to implement new compensation strategies to be able to attract and retain top talent. Matter of fact, the year later, Small Business Administration did another study in conjunction with CNBC and said that 52% of small business owners said it's even harder to find qualified people to hire compared to the year before. And that when you get them hired, it's hard to maintain them or to retain the talent. So I think it's a big opportunity here where we could place a very valuable policy for your business owner clients. There's struggles, the hurdles with individuals. That's another one of the reasons I think this is a good topic to talk about now, because there are hurdles when you want to try to get a policy deduction on an individual basis. So what we're seeing here is what we call the age-based caps. Now, this is what, as an individual, you can take in terms of a deduction on your personal income taxes if you meet a few thresholds, and we'll talk about those thresholds later, which is basically itemization and a 7.5% adjusted gross income threshold off of your personal taxes. For individuals to itemize, number one, you have to, on your Schedule A, you have to itemize your deductions. Now, some of the struggles with that, I believe, are number one, you know, the majority of folks that we talk about in long-term care are typically in their 60s, maybe middle 60s. And one of the largest, I guess, items for itemization would be a mortgage interest deduction. And a lot of our clients have their homes paid off. With that deduction being so high right now, I just don't see a lot of the standard deduction. I just don't see a lot of itemization taking place. Now it could change. So at the end of 2025, when the Tax Cut and Job Act sunsets, we could see a few more people starting to itemize. But right now, I'm just not seeing a lot of those. And because again, not only do you have to itemize, but your medical expense also has to reach a 7.5% adjusted gross income threshold in order for you to take that age-based cap. So there's just a lot of hurdles to overcome when we're talking about individuals taking a personal deduction for long-term care. I'm glad it's there. There's just hurdles to it. So what does it look like for an individual? Well, first of all, as Brad mentioned, any of the quotes that you've seen will show a breakdown between the base life insurance premium and the long-term care premium. So what we're going to take a look at is that base premium that's in the gray, so that's not going to count. And the deductible here, that's the continuation of benefit. And also there's a little cost for that acceleration of benefit. We'll just call that the long-term care amount. That's going to be factored into the calculation. Once you have that number, then you're going to compare that against the age-based cap. So depending on how old your client is, and this does change from year to year. As a matter of fact, the cap went down a little bit this year, which is the first time in several years. But you're going to compare it against that age-based cap. And you're going to take the lesser of the two. So if the premium is lesser than the age-based cap, then you can deduct up to the premium. If the age-based cap is lesser of the two, then you'll take the age-based cap. But remember, the client has to itemize, and their medical expenses have to meet a 7.5% threshold of the adjusted gross income. So essentially, this is what it would look like on your Schedule A. You would, after you include the deductible portion of that age-based cap or the lower of the premium, then you'll add that to your other allowable expenses, and that's what you could deduct on your personal income taxes. But let's talk about it here in the business market. Now, this is really kind of the meat of the conversation today, and why I think it's so exciting and an opportunity that's right in front of us right now. In the business market, let's talk about tax treatment for sole proprietors first. Now, we're talking about sole proprietors that file either the Schedule E, C, or F. And with that, they're going to be able to take a self-employed health insurance deduction. Now, this is above the line deduction, so we don't have to itemize, and we don't have to meet that 7.5% adjusted gross income threshold. So there's a bonus already, just if you have your own small business that you're buying long-term care through your business. Same thing, we're going to take a look at the base premium. We're going to take a look at the deductible, the potentially deductible portion of long-term care premium on your quote. You're going to compare that against that step 2, that age-based cap, and then we are going to be able to deduct the lesser of those two on our personal tax returns. Now, this is where I think it gets really exciting. For the employees of a sole proprietor, if you look on the left-hand side, the sole proprietor gets to deduct the entire cost of the policy. And when I say the entire cost, I mean the life insurance and the long-term care insurance. So both that base life premium and that long-term care premium, they'll be able to deduct that. The premiums for the long-term care portion are excludable from the employee's income. So what does that mean? You're essentially giving them a free long-term care policy. They will get taxed on the base life premium. Always going to get taxed on that base life premium. Now you can set it up so that you're actually double bonusing. So you could provide a bonus that's large enough to pay the taxes on your original base life premium and pay the taxes on that double bonus. Now the benefits, because like Brad was talking about, under 7702B of the Internal Revenue Code, those benefits, those long-term care benefits, are tax-free. The death benefit on the policy is tax-free to the beneficiaries. And again, because this is an accident and health plan, it is not subject to the ERISA guidelines. So you can discriminate among the employees, meaning you can pick and choose the employees that you want to cover. So if you have some of those key employees, or you can also vary the amounts of coverage between employees. So let's say you have somebody a little bit younger, somebody a little bit older that needs some more coverage, because they don't have time to build their own coverage. You can do that here with the anti-discrimination rules. All right, let's talk about the tax treatment in an S corporation for a greater than 2% shareholder. Now, don't ask me why the IRS put that special provision in there, but it's not a 2% shareholder, it's greater than 2% shareholder. Here, it's going to be folks that file those 1120Ss for their corporation. And when they file their 1120S, they're going to basically be able to deduct the total cost of the life insurance base policy and the long-term care policy, that continuation benefits rider. They're going to be able to deduct that as compensation of officers for the owners. Here's what it looks like. Corporation is going to pay the entire premium. Now, it says long-term care premium because that's what we're going to focus on, the deductible. But I want you to understand that the company is going to pay both the base life premium, and they're going to pay that long-term care premium. So that is what we're really looking at here as to an individual buying it through the company. What is the benefit? Well, the entire premium is going to be treated as compensation. So the business gets to take it off as a deduction, but the individual owner is going to receive a W-2 for that full amount. Then they're going to be able to turn around and deduct that premium up to the aged base cap. If you have a joint policy for the owner and his or her spouse, you'll be able to deduct up to both of their aged base caps as an above the line deduction. No need to itemize, no need to meet that 7.5% adjusted gross income threshold, just an absolute above the line deduction for your long-term care portion of that premium, the lesser of either that age-based cap combined if it's a joint policy, or the premium amount, whichever is lesser. Moving on to the employees of the S corporation. This is very similar to the sole proprietor, because again, the employees do not get taxed on the premium for the long-term care. So the corporation is going to deduct the full amount. They're going to deduct the entire premium. The base policy is compensation to the employee. Employee will get the W-2 on that. Again, you can double bonus the employee to offset those taxes, but the employee will not get taxed on the long-term care portion. Now, again, just like with the sole proprietorship, long-term care is not subject to the anti-discrimination rules. So now let's talk about the tax treatment in C corporations for shareholders. Now, this is a nice, in my opinion, this is the best scenario for long-term care in the employment setting. If you have a C corporation, we're talking about the corporations that file the Form 1120s. You'll see about 3 areas on that 1120 where this premium will be added or listed underneath compensation of officers, salaries and wages, or employee benefit programs. Here's how this looks now. Now notice that this slide talks about C corporations, shareholders, and employees. In a C corporation, the owner, the shareholder, is treated as an employee. So this is where it gets really, really beneficial. The corporation is going to deduct 100% of the total cost of the policy. And that's going to be for the employees and the spouses, and actually you should say dependents as well, and the shareholder employees themselves. The long-term care premiums are not considered taxable income to the employee. So even though the corporation is deducting 100% of that premium on the life insurance and the long-term care, you as the owner or a non-owner employee will not be taxed on the long-term care portion. You will receive a W-2 for the income off of the base life premium. Again, we can offset that with a double bonus. And again, these are not subject to the anti-discrimination rules. So the corporation here can discriminate by class. Now, when we talk about class, maybe you'd say, directors and above, or folks that have 20 years of I guess, employment history, or 15. You could set it up by a class here, but they are fairly loosely defined classes. My partner, Kelly Hall, CPA on the team, was asked whether or not a C corporation owner could just put it in place for himself or herself. Technically, the letter of the law, yes, but I do think it looks better. She said, she agreed, it looks better if you have at least another employee or another shareholder that's on there with you as well. And so you're covering, 2 individuals. So if you look at the continuum of the least favorable to the most favorable, least favorable in terms of long-term care premium deduction would be if you are buying this on your own on a personal level, because what you have to itemize. You have to meet that 7.5% medical adjusted gross income threshold. And then as we move to the right through sole proprietorship and those pass-through entities, those S corporations, even partnerships. Partnerships are treated similar to S corporations in terms of the taxation that occurs on the income from the entire premium to the partner. Partner is able to then take that age-based deduction up to that age-based deduction. But then we move over to the right on the C corp, and that's the most favorable, as we just talked about. So you can see as the business it starts using their checkbook to pay for these long-term care premiums, we start seeing additional opportunities develop that folks might not have been aware of. And I think this is why this is exciting at this point in time. A lot of agents will talk about executive bonus plans for the key employees, but there aren't many yet talking about executive bonus using asset-based care, long-term care. So I think that's where a huge benefit is, because of the ability to give your employees an essential free long-term care policy. Now, the mechanics of an executive bonus plan, in general, this life insurance plan is going to be set up for 1 or more of your key executives. Now, keep in mind, the employee has to be the owner of the policy. In order for a business to be able to take a deduction for any the life policy or the long-term care policy, the business cannot have any incidents of ownership. So it has to be the employee owning the policy. Now, a lot of you might throw up a red flag and say, well, wait a minute, what if I buy this policy and the employee leaves in a year or 2 years? You can put in a place what we call a restrictive bonus agreement. So there's a restrictive executive bonus arrangement. People will hear those called REBAs sometimes. And you can actually put provisions in there. You must stay employed 5 years, 10 years. You can have a vesting schedule, if you will. You can have penalties for early termination of employment. You can have certain the ability to restrict actions on the policy, such as the inability to take a loan against the policy without your written permission by the owner of the company. So you can do certain things like that. The IRS will allow, but the IRS just doesn't want you to have too much control to the extent that it looks like you have any ownership interest in the policy, or you're not going to get that deduction as the business. But here, then, once the employee is the owner of the policy, the employer is going to pay that base premium as a bonus, and then the long-term care is going to be treated as health insurance. So again, the employee does not get taxed on it. Regarding taxation, then, the employer receives a deduction for all the premiums. The employee is taxed only on the base premium. We can do that double bonus to offset those taxes. The employee is not taxed on the LTCI premium. So LTC benefits from the insurance policy, they are tax-free, and the death benefits receive tax-free as well to the employee's named beneficiaries. So if we're sitting down at a lunch table and we're talking about it, this is what it looks like in its most simplistic terms. Employer pays the premiums on asset care. There's a base policy, and that base policy is W-2 income. That base policy is that base life insurance policy. The long-term care portion, not taxable. That COB, not taxable to the employee. The death benefit proceeds to the beneficiary, and the long-term care coverage are all tax-free as well. Now, when you do put these in place, there are certain documents that are required, and these documents we have copies of for you, and Brad can get those to you. I can get those to you as well. There's specimen documents that you can provide to your clients, value added. Oftentimes, if you can help to reduce the billable hours from your client, small business owner who have to utilize the services of an attorney, maybe that attorney's not necessarily familiar with maybe a restrictive executive bonus arrangement, but we have the sample documents for you that we can provide to you. So please let us know if you have any of those questions. We have sample documents for pretty much anything. And I will tell you this, you may run into a situation where, and this was actually a CPA that was, I think, a tax attorney and a CPA on a case that my partner worked on. And the CPA told the business owner client, your spouse has a health insurance plan available through her work, and so you're not going to be able to take a deduction as the business owner. And that was not true, because if you look here at IRS publication 535, and I'm not sure if you can see that, it's kind of small on the screen. The rules are applied separately to plans that do not offer long-term care policies. Most everybody at work has a policy that's offered to them that covers health insurance. Not very many have a policy that offers long-term care. So the IRS came back and made a differentiation between those two. So if you do run into that, just know that there is some authority that would tend to support and your position that no, you can't take this off as a business owner as long as your spouse does not have that same type of long-term care coverage available through his or her employment. So that is I guess the short version of the long-term care premium being paid in the business market. So I'll see if I'll open it up to questions now if anybody has any questions.
Well, AJ, before we get to questions, I just wanted to add to this. You showed some great specimen documents right there, and there's plenty more depending on the situation, that occurs or what type of business entity. What I'll also share, and Lisa has these at her fingertips as well there at One Resource Group, but we also have a consumer-facing one-pager. So front and back consumer-facing one-pager that is a bit of a summary based on whether it's a business entity or even using health savings accounts to pay for the premium. So what I'll ask you to do, AJ, if you get a quick drink there, is just touch briefly on using an HSA and how that works, because a lot of times in the trainings that I do across the country, I just simply ask for those agents and advisors that are in the room, how many times do you ask your client if they have accumulated health savings account dollars? And many times they find that they do, they're just not using them. It's just sitting there. And how can we use those to pay the premiums?
Yeah, so the IRS does allow for HSA premiums to be used for long-term care premiums up to that age-based cap. So if and a lot of times people will say, well, can I take a deduction as well? No. So because those are tax qualified dollars, that you're using there. So your pre-tax dollars, you are not able to take a deduction and pay the premium, but absolutely, Brad, that's a great idea. They're absolutely available for long-term care policies for both you and your spouse.
Yeah, and most of the people that dial into these webinars know this, but remember, with HSA dollars, that client is not forced to use them during that calendar year, and that's why they continue to accumulate.
Right.
So that's the first piece that we have available, which is nice for you to have. Maybe you're in front of that business owner or that individual, and you can show them this, overview. Now, the second piece that we have as well, for those that like to study a little bit deeper, is we have a full advanced strategies guide for this. And it was put together by AJ and Kelly Hall on our team. And they review that every single year and update whether it be the numbers or if there's changes in code. And so, but that's not for consumer use. That's basically for your training eyes only. And so remember that when you're asking One Resource Group for different pieces on this subject matter to help you at the point of sale. So with that, Lisa, I'll turn it back over to you for any questions that we have in queue or any that's on your mind as well.
Awesome. Thank you, Brad and AJ. Very, very useful information there. I'm sure we're going to be getting some calls to help out on that. So some of the questions that we do have is, what happens if someone were to, say, surrender the policy because they left the company, because the policy can transfer with them when they go, correct?
That is
and
correct.
if they surrender it, would there be a tax consequence to them? Because the company,
because they're being taxed on it already, then there would not be any additional surrender taxes on the surrender, because they are paying those taxes as the premiums are accruing on those base life policies.
Okay, and on these type of policies, do you typically see the corporations or businesses doing like single pay, 10 pay? They don't normally do like a lifetime pay, would they?
Well, I do see lifetime pay. I mean, Brad, you could probably speak to this as well. I do see multi-pay because remember, those deductions are available on an age-based cap, especially if you're the owner. Now, it doesn't matter if you're the employee, like on a C corporation or any employees. The age-based cap doesn't matter. You're able to take that full deduction. So if you pay $5,000 a year in a premium as a business for that employee, you deduct $5,000 as a business. So I do see multi-pay typically because then they are able to extend that deduction out over a number of years. Sometimes I might see a single premium if we're dealing with a C corporation because they're able to take that premium off as a deduction for the business. So that might be attractive for a lot of C corporations that have like retained earnings. But keep in mind, you're going to get a W-2 for that entire premium on that base life policy. So if you have the ability as a business owner to absorb that, or as an employee, it's a conversation that you can have with the business, or if you're the owner, I guess it's a conversation you can have with your accountant as to whether or not that would be a good idea to pursue. I just don't see a lot of it in the business market, honestly, in terms of single premiums.
Yeah, and so Lisa, this is a great question because we get asked a lot, should we consider, like in our case with One America, what's called pay to age 95, a lifetime pay, right? Or one of the limited pay options, so 5, 10, maybe 20 pay. And it really does depend. I mean, if we have, let's say, a group of either, owners or key employees that are now in their early 60s thinking of retiring in the next 5 years, a lot of times we'll see 5 pays. But I would say the most popular, probably by far, is going to be the 10 pay. I don't know why. It just seems to be the sweet spot of where they want to see a finish line with using those business dollars, and plus it lines up with the demographic of where most clients are starting to consider long-term care planning in their early to mid 50s, and then plus 10 years that will put them in that kind of mid 60s range to have the premiums finished paying. So that seems to be the most popular.
And I apologize, I do want to back up real quick. Just like any other policy that you would surrender, you would get taxed on the gain in the policy if there's any gain on the cash value. So that's going to follow you regardless if it's employer purchase, or you purchase it on your own. So just want to clarify that.
Okay. Awesome. Glad that was a good question. So with the One America's products, we have the joint products, and you kind of mentioned that we can have the husband and wife on there, correct?
That is
and
correct.
have the corporation. I mean, because it's going to just be one single premium, or well, not one single, but it's going to be, the base and the COB premium, not broken down by husband and wife, correct?
Correct. That is correct.
Okay. Let's see here. Okay, so say the company says we're going to pay X amount of dollars to, help fund a long-term care policy. Is there a way, or can the employee pay an additional amount, the corporation still get their benefits, and the employee pay an additional amount on top of what the corporation's paying to maybe get a bigger policy? Does that make sense?
Yeah, that would be fine. I think you just have to work that out with One America, because they're going to want the premium at the same time. My partner Kelly, the CPA, she says that although business owners can stroke a check themselves and then reimburse themselves from the company and still get that ability to take that above the line tax deduction, she said oftentimes that the IRS really looks to who strokes the check. So really, for the business to be able to take a deduction, the business should be stroking that check. So it could potentially be something, and you'll have to talk with the business accountant, that they make that premium payment at the same time. Maybe the company pays the premium. I mean, that's going to have to be like on an individual case-by-case basis. Don't see that happen a lot, but that is a good question, Lisa, because certainly if they want to provide a benefit but not buy the whole house, that might be something that I don't know, Brad. That's a good suggestion, but that would have to be worked out with with One America and probably the accountant.
Right, because if the corporation is going to cover some of it, and it's maybe not quite what the client, they'd like to get a little bit more, that'd be a nice option. But that's where we can get them in contact with your advanced team to try to iron out what needs to be done.
We'd have to work with probably our new business department. We could get it done.
Yep.
All right. Well, awesome. I think that's all the questions that I have for today.
Brad's your troubleshooter. He's the go-to.
Yeah, I was going to say, AJ
That's
and
awesome.
Kelly, they're rather busy. They can help point us in the right direction, but I absolutely can work with our new business team on things like that, Lisa.
All right. Awesome. Well, I thank you all for joining us today to discuss One America financials, tax deductibility of LTC riders and linked benefit products. Brad and AJ, once again, thank you for taking the time to discuss One America financials products. By the way, they just rebranded their name, so make sure you check them out. And and please remember to check out our LinkedIn showcase page for useful information from the LTC department. We have a lot of times where we're putting information out there for you from the carriers. So once again, thank you everybody for joining us, and have a great day.
Thank you.
Thank you.